I mean, let's face it, that dealing whether it's gold, silver, oil, copper, whatever, derivative markets is an extremely profitable business.
Well, hello there, my friends. Chris Marcus here with you for Arcadia Economics, and very fortunate to be joined again by Alasdair Macleod of Gold Money, who has been on the show several times. Probably been too long since we've caught up, although Alasdair doing great research as always, and it's a pleasure to have you back on in here. And how's everything going with you today?
Well, it's my pleasure to be back, Chris, and everything's as fine as it can be.
Yeah, certainly a challenging time in the world for a lot of people, although things happening on the banking side. And I thought to start off with, it would be interesting to get your feelings on what's going on with Basel III and any changes that that has actually brought into the market now that it's, I guess, just about a year since that started going into effect. And perhaps you could bring people up to speed on what you're seeing there.
Yeah, I mean, it just hadn't really had all that much effect. I mean, one's got to understand that it's a background situation, and that is that it doesn't stop bullion banks or banks dealing in commodities or derivatives of commodities. It just makes it a bit more expensive for them to do so in terms of the overall allocation of their balance sheet. So um, I mean, let's face it, that dealing in whether it's gold, silver, oil, copper, whatever, derivative markets is an extremely profitable business. And even though notionally they may have staggeringly high short positions, um, you know, in general terms, as long as they keep trading it, they will make money, and they make good money. And so I don't think we see any sign of it yet forcing traders, if you like, to be shut down by their banks. But there is no doubt that behind the scenes, the treasurers in banks will be looking at the management of their overall balance sheet, and they will be seeking, certainly not for their trading desks to increase their positions, but quite likely to decrease them over time. So I think that's the background of Basel III. We saw something come out of this. I think it was the Office of Currency Comptroller, I've probably got the wrong term, in America, which reallocated gold derivatives from foreign exchange category into commodities category or precious metals category. And so suddenly you saw this sort of huge, great spike of positions. A lot of people took it that this was, this was, sort of rather sudden. But actually, if you read the note and the explanations behind it, it was quite clear that this was just a reallocation, if you like, within the Comptroller of Currency's books. And so that's the sort of thing, and that is in accordance, again, with Basel III. So we have an establishment which, in terms of Basel III, is looking at gold and silver as not money, having removed it from the foreign exchange side of derivatives, but actually is a commodity. That's the way they're looking at it. So this is pure Keynesianism driving it, because legally gold is money. I mean, it's as simple as that. Gold coin is money. Everything else is credit, as the original J.P. Morgan said. And he wasn't stating an opinion, he was stating a fact, a legal fact. And that is still true today, even though government administrations don't like you holding gold. They banned it in the past, as you know, in America in 1933. But it's still legally gold, and it has been since Roman times. And it's been used as gold a long time before that as well. But it was formalized in Roman times, still true today. And that also goes for silver coin and copper coin.
Yeah, and in terms of that derivative position we've seen, can you put into perspective the composition of that, or what impact that's having on the markets? Obviously, we have the JP Morgan trial going on, and we see there have a large derivative position. Can you explain to folks what that actually means?
Well, yes, it's interesting because when that chart came out, it came out more or less, I think it was actually part of an article that Peter Hambro wrote. And Peter Hambro has been in the gold market, going way, way back. I mean, from the 1970s onwards. And he was saying, and it was absolutely clear, that the Bank of International Settlements, working with the exchange stabilization funds of the major nations, had a deliberate act of policy to turn the gold market from a physical market into something that they could manage. And that was the birth of unallocated gold positions, which were backed by nothing other than paper. I mean, credit, not the physical stuff. So by doing that, it was a deliberate act of policy to remove demand or take demand away from physical gold and shunt it into something which people think is the equivalent. And the thing that was interesting is that in that chart, you could see that there were two major players. You had JP Morgan and Citibank, or Citicorp, whatever they call themselves nowadays. And it is quite clear, if you take Peter Hambro's message about the Bank of International Settlements, exchange stabilization funds, etc., and combine it with the evidence from that chart, you can see that actually JP Morgan, in particular, and to a lesser extent Citibank, are purely agents of the US Treasury. They are leading the US Treasury's assault on the gold price. And it's as simple as that. So we now have a situation which, they've overstepped the mark, if I can put that very, very politely. And as a result, they were fined hugely for trades which they did several years ago. I think it was what, $930 billion or something, some incredible amount.
920.
I can't remember whether it was billion or million, but anyway. It was
920 million.
920 million, thank you. Okay, millions, not billions. Should be billions, but anyway. So they were fined for acting as the Treasury's agents. And now we find that their senior dealers, in the way they conducted themselves, they're now on criminal charges. So I think that is basically the situation. It's ironic that the Fed's agents have found themselves guilty of breaching the law, guilty of criminal charges. So, what more can one say?
Yeah, well, one of the questions that's come up with that trial, we've seen them talk about the spoofing, and it seems like went in both directions. And some people are wondering, okay, does that mean just it's manipulated, or is the price pushed down lower? We did have the comments from Peter Hambro, and there have been other data points that have popped up. But what could you say to folks who are wondering how to distinguish whether it's just that there's illegal behavior going on there, or if they have indeed left the price lower than it would be in a free market?
I mean, basically, it's very easy to get the price down, manipulate the price without resorting to criminal activities. I mean, the criminal activity is spoofing. Let's make that absolutely clear. But dealing in such a way to manage the price is actually not illegal. And it's very easy to do. I mean, if you have got the resources to do it, and banks generally have, because they can create the credit out of thin air in order to do it, then they can dump 10,000 contracts on COMEX, for example. Yeah. And that would have an immediate effect on the price. And they would do it in, quite publicly. They will know from their trading book where all the stops are, the bull stops. And so they know how to take them out. I mean, it's the easiest thing in the world to do. If you can print huge amounts of credit in order to create a short position, then it's money for old rope. It's as simple as that, and that goes on all the time. We haven't seen very recently the sort of 5,000 and 10,000 COMEX contracts being deliberately dropped at the wrong moment. That seems to have ceased for the moment, but it's happened in the past. I wouldn't rule it out again. But I think now with Basel III, there is this tendency to try and restrain the positions for most of these banks rather than increase them. Now, whether that's true of JP Morgan and Citi, who are obviously acting as the US Treasury's agents in this, I honestly don't know. I can't make that assessment, but I would have thought that it's sort of kind of difficult. And perhaps also, having gone through this bit of trying to control the gold price and if you like, take attention away from it to try and persuade people that gold is a pet rock, whatever. I think all that has sort of diminished a little bit. And I think the priorities have changed somewhat. So perhaps we're not going to see that dumping of 10,000 contracts, etc. again. And of course, we're now in a very different environment because we have a very fragile global banking system. You look at the leverage in banks, it's very, very worrying, particularly in the Eurozone and particularly in Japan. I mean, you've got balance sheet leverage of over 20 times, and that's taking asset to equity ratios. And the equity funds in there, they're traded in the market at a very substantial discount to book value in almost all these banks. The exception, the honorable exception, actually, is the American banks. The major American banks trade usually at a premium to book value. But you look at some of the banks in Europe. I mean, the G-SIBs, the global systemically important banks, the ones which will transmit systemic risk across the world. I mean, they're trading at something like 20 to 30% of book value. Now, that's option money on the survivability of a bank. It's giving us a clear message that these guys are in trouble. So I think generally it's an environment which banks will not want to increase their overall risks. They, I think, are contracting their balance sheets on if they can, and that's the way it's going, rather than expanding it into yet more derivative activities.
Yeah, do you think that's what we've been seeing in terms of the gold and silver positions being reduced, the banks getting actually net long silver on the swap dealer report, pulling back in the gold market as well? And is that also connected to the Basel III regulations?
Well, I think you could say that, but if you look at the cycle of behavior over time, I mean, basically they pull it up, suck you in, push it down, shake you out, and it's just, they do it time and time and time again. And it's difficult at this stage to know whether that's only what they're doing, or whether this time around, I mean, particularly after the scare they had in 2000, when the Fed reduced the funds rate down to zero, you remember in March that year, at that point, the gold market just took off. I mean, it had already fallen, I think, from something like down to 1480 or something like that, and then it was straight up to 2000. So that might have concentrated minds a little bit about getting too short. So yeah, they want to get an even book of that. That is absolutely clear, and that, I think, is independent of Basel III. I can't see that Basel III is a reason why they would do it. I mean, Basel III, as I said earlier, I think is something that the treasurers in the banks look at rather than the dealers. The dealers will deal with whatever resources they're provided by the Treasury. And I think that's the way round in which the Basel III thing is working.
Do you think it could be some impact from what we saw in the nickel market, which was right around the time that we saw this shift in gold and silver, and certainly plausible that, they could have been concerned after watching that?
It wouldn't surprise me at all if we have another nickel event. And I would have thought that the commodity which is at greatest risk of that is probably silver. Yep. I mean, what we see is silver is probably the most important metal for this new electronic age, with solar panels, with the electrification of transport. I mean, the whole thing. Silver is desperately important. When you look at the price of lithium, how that's shot up, the price of uranium, how that's shot up. I'm talking about non-fossil, commodities involved with the non-fossil environment. Silver has been very much left behind. And I was reading something sent out by researchers from, I think it was Metal Focus, that the demand for silver in India has just taken off. I mean, it's been huge in the first half of this year. And for that reason, we've seen stocks in the London vaults have been declining. So, yeah, I mean, there's no physical around. I think generally that is true to say. So you've got a situation where, I mean, if I was a bullion bank, I would want to get an even position or even a slightly long position under those circumstances. And I'm sure that, at some stage, particularly if this thing, if we get a systemic crisis, which in the banking system, I think is beginning to be recognized as a real likelihood again, then, what do you want to do? I mean, if you can't get your gold shorts back, then, you might be able to defray the loss a little bit by having a long silver position. And I'm so, to my mind, I think that it is quite likely that silver could have that sort of spike. Now, having said that, the LME has, I think, stopped dealing in silver. I haven't looked recently, but I read somewhere that they've stopped dealing in the precious metals. LME precious has been closed down. So I don't know. Sorry, excuse me. I don't know, but I would say that silver certainly is likely to have a huge, great squeeze at some stage. And that's the metal I would put my money on for a repeat of the nickel situation.
Well, that would certainly be welcome news. And you mentioned that some of the conditions that are happening now, we're recording on Tuesday, and here was the IMF cuts global GDP, raises inflation outlook, warns world teetering on the edge of recession. You've also written about some of the things that are happening in Europe. And of course, we have the Fed raising interest rates in the US, which has created problems around the globe. And what could you share there to put that into perspective for people?
Yeah, the two things I think we need to take on board. The first is the obvious one, and that is that the interest rate environment has changed completely. From about 1980, interest rates have been in a long-term decline trend. And that ended with the Fed at zero. It ended with the ECB at -0.5. It ended with Japan at minus whatever it got down to. Japan is still there, asleep at the switch. The ECB is just waking up a little bit. The Fed is already moving rates up, and we're going to get another meeting, I think this week, aren't we? This is being recorded, on the 26th? So, yeah. And the Bank of England has woken up a little bit as well. The fact of the matter is that interest rates, official interest rates in the region of 2%, are way behind the curve. I mean, we've got inflation rates measured by the CPI in the region of, closer to 10%, basically. And we've got the RPI here, which was discarded some time ago because it was costing the government too much in indexation. So they swapped it for the consumer price index, but that's now running at 11.8%. That's an official inflation thing. So to have a bank rate at around about 2%. I mean, it's a broken market in effect. What they're doing is they're saying that, if we can just ride this out, it'll come back to 2%. The reason we got such high inflation is that, first of all, we had the problems with supply chains, and now, of course, we've got this Ukraine situation. But Putin's bound to lose that one, and then everything will return to normal. Well, dream on. I mean, no, this is wrong. I mean, I was looking at our official statistics and forecasts here, and they're still talking about it going back to 2%. CPI back to 2%. So that's if you like, the first thing. The second thing, which I think is also part and parcel of this problem, is something that Jamie Dimon said at a banking conference at the beginning of this month. He stood up and he said, a couple of weeks ago, I said that the economy was facing storms. I'm upgrading that to a hurricane. We face a hurricane. That's what he said. Now, his chief economist rode back on that. And said, "Oh no. I don't think he quite said his boss misspoke. I mean, you don't say that about Jamie Dimon, but I can tell you what, Jamie Dimon was saying something terribly important, and that is that at the margin, JP Morgan is going to reduce its outstanding bank credit, because his message was basically there is too much risk for a bank which is highly leveraged. We do not want to get caught out. We do not want to get caught out with counterparty risk." So coming back to what you're saying about gold, look, I think Jamie Morgan is in, if you like, a mode to sort of start shutting down a lot of JP Morgan's operations. I mean, obviously, as the Fed's main channel into the US banking system, there's not a lot he can do in certain respects. But I'll tell you something else, and that is that any other banker, because they all work as a cohort, they all think the same way, they all have the same problems. Any other banker who has not already worked out that he should reduce the outstanding bank credit that he has in the market on his balance sheet will certainly have noted what Jamie Dimon said as the leading commercial banker in the world, and will now be very seriously thinking of doing so. So we got, on the one hand, rising interest rates, and on the other hand, we have the potential for a massive contraction in bank credit. Now, what does that do? It means that banks basically call in loans. We've already seen them, if you like, reducing the outstanding loans backing speculation in financial securities. I mean, if you look at the NASDAQ figures for margin debt, I mean, that's come down quite sharply. It's still very, very high, and it's got a long way to fall. You'll see them basically freeing up their balance sheets where they can. And a lot of that will be turning around to companies who have overdrafts and saying, we're not going to either not going to renew your overdraft facility, or we're going to reduce it. Oh, so what does that do? It means that companies which don't make enough money to cover their expenses are going to have to start cutting quite hard. So what we're looking at is a situation where rising interest rates, through the effect of contracting bank credit, is going to contract GDP, because GDP is no more than the sum total of credit in the economy. That's it. That's what it is. It's no more than that. Don't think that GDP actually tells you what's going on in the economy other than the expansion or contraction of credit. So, and this is something that all politicians, all Keynesian economists get absolutely wrong, simply because they don't understand banking, they don't understand money, and they don't understand credit. GDP, quite simply, is credit. Now, if the banks are going to start contracting credit, then GDP is going to fall off a cliff. That is the message that we were getting from Jamie Dimon. And that is why, I guess in the background, the Fed turned around and said, oi, you can't say that, for Christ's sake. So, and that's why the chief economist was instructed to sort of row back a little bit, if you like, and no, all that sort of stuff. But I tell you that the thing that really matters is what's going to happen to bank credit. Banks are highly leveraged, and they're particularly highly leveraged in the Eurozone and also in Japan, where their leverage is over 20 times on average. And if you look at the Eurozone, the worst is Group Crédit Agricole at 27 times assets to balance sheet equity. And you look at the share prices of these banks, they are all standing at massive discounts to book value. What does that tell you? It tells you that the market's saying that these are not good investments, they are unsafe. Normally what you would do is you would try and buy things which are cheap because they are close to book value. This is deep discount to book value. This is not good news. We have a banking crisis on the way, because if you have a contraction of bank credit, it's the cycle of bank credit, which happens every 10 years. This has been going for 13, so it's a bit too long. I mean, when this one happens, when this one blows, it's going to be far bigger than what happened back in 2008, 2009 with the Lehman failure. This is a very serious situation which we face. So those are the two things to look at: rising interest rates. And of course, the other thing is, if you look at the Eurozone banks rely on their liquidity for their liquidity on the repo market. And what they do is they push in collateral, most of which is bad debts, but has been passed by the local regulator. Oh, it's all right as long as you get it off my patch. So that goes into the Target 2 system. They get cash back. The amount of the size of the repo market is 8.7 trillion euros last recorded. Now compare that with the other way round in the US. The reverse repos are $2 trillion. Right. So that gives you an indication of the seriousness of the situation in the Eurozone. You raise interest rates, then that liquidity for the banks dries up. I mean, they should have liquidity. The way a bank works is it creates liquidity by making loans, because on the one hand, you create a loan, that's an asset on your balance sheet, but you've got to have something on the other side of the balance sheet to counteract it. And that quite simply is a customer deposit. So, one balances the other. So it's easy to create liquidity. But your problem is that in a stagnant economy, and an economy where the regulator says, well, lending to commercial entities is risky, which is what the regulators have said, lend it to governments instead, you can see that the whole situation is actually very, very precarious. I mean, I'm just touching the surface of the problems within the global banking system. But believe you me, watch out for the contraction in bank credit. It will be recorded as a recession. It will be recorded as a slump, because everybody makes the mistake of automatically thinking that the contraction of credit is, or rather the expansion of credit, which is the way it usually happens, is growth, economic growth. It's not at all. It's just the expansion of credit. The contraction of credit is very, very severe because of the signal it sends to you that actually it's not so much people not spending, companies not producing. No, it's banks not making credit available. That's the key thing.
Yeah, and that's what really struck me after studying Austrian economics coming out of the housing bubble, where when you're adding credit in there, things seem good, yet when you remove the credit, that's when you run into trouble. And it seems like we're seeing that play out right now, and as if there's no easy exit from this position, because the Fed can raise interest rates, but runs into the problems that you've mentioned. And do you feel that this eventually ends with just a reversal and a spewing of more credit and Fed paper into the market, or how else does it play out?
Well, basically, the central banks will ensure that the commercial banking system doesn't fall over. I mean, that is one of their primary functions. It may not be quite so easy to do as in the past, because you've got the complication of all the G20 nations having mandated bail-ins as opposed to bailouts. Now, what that means is that the central bank turns around in the case of a failing bank and reallocates balance sheet liabilities from loans to a bank and deposits, customer deposits, reallocates that into equity. So that way you improve, if you like, the relationship of equity to total assets in order to be able to cover the losses on the asset side. I think, however, that's a very, very dangerous thing. It might work in the case of an isolated case, but when you have a high level of systemic risk, all that does is it means that bondholders, or indeed counterparties through the money markets, for which banks require on marginal liquidity, will just refuse to lend any money to a bank which hasn't got, really sort of top reputation, security, good balance sheet, the whole lot. So what you do is you actually, but if you even try to do a bail-in, I think what happens is that the whole system unwinds very, very rapidly. that may not be an issue, because if the Eurozone system falls over, that's a far bigger deal. It really is. And as far as London is concerned, I mean, London is the international center outside the dollar world, as it were. It would absolutely collapse the UK banking system, I would think. All the interbank settlement systems, the centralized systems are all based in London. So for euros, for dollars, for the lot. So, the knock-on effect, I think, is immediate and really rather frightening. And so I can see a situation evolving out of current events, which leads to complete destruction of the banking system. And the response from central banks will be to take all those responsibilities upon themselves. Now, whether they wrap it up in a bad bank or whatever is immaterial, but they will take on those responsibilities. I have no doubt that they will try and support financial markets to try and keep confidence going, rather than letting confidence just go out of the window. I have no doubt that they will make easy money available to corporations who, we would call in Austrian terms, malinvestments. But as far as people who are not Austrian economists are concerned, major corporations who might not be profitable enough to pay higher interest rates, sort of thing. And so what this amounts to is the rescue of the financial system will be very much at the expense of the purchasing power of the currencies, because the expansion of credit involved, I think, will just undermine the currencies. It is a repeat, if you like, of the John Law situation, which I've talked about many times, in 1720 France. When in 1720 France, he tried to support the Mississippi share price in February 1720. And he did that basically by printing credit, printing his livre, which weren't backed by anything. At the same time, he tried to confiscate as much specie as he could. That didn't stop the slide in the currency. And the way in which particularly Richard Cantillon made money, he was a banker at that time operating in Paris and also London, was he shorted the currency. And he was dead right, because by September, the Mississippi venture still had some sort of share value. It had fallen from around about 12,000 livre to about 4,000 livre. But the problem was that the livre went down the pan, and by September, there was no quote for it in either London or Amsterdam, which were the two foreign exchange markets at the time. So the currency, I think, could the currency could lose all its value under these circumstances. That is the danger. And that's why I think you've got to have real money being gold coin, silver coin, also copper coin. I'm not suggesting that we run out and buy copper coin, but or buy copper, but you can see that there will be a flight into real money, and it will be flight into real money by not only central banks, Asian central banks, but people like you and me. Because if you haven't got it, you've got to damn well get it, because your dollars won't buy anything under those circumstances.
Yeah, and last question along those lines. Obviously, we've seen everything escalating with Russia and Ukraine, but to the currency component, using gold as a backing temporarily, and obviously we've seen the reports, hard to get official data on how much gold is going into China, but how does that connect with everything else you've just laid out there?
Well, it's a very interesting question, because there is no doubt that China and Russia, and indeed all the Central Asian nations, have been accumulating gold. I made the assessment that by 2002, when the Shanghai gold exchange was opened, and people, were then allowed to buy gold and silver. Chinese citizens were allowed to buy gold and silver. By then, I thought that the state had acquired for itself, in various accounts, around about 20,000 tons. I might have been 5,000 over or 5,000 tons less. But I mean, that's the scale of it at that time. And clearly the signal of opening the Shanghai Gold Exchange was the state saying, right, we have got the quantity of gold that we are satisfied with for our purposes. Now we will let the people accumulate. And since then, I think if you look at the statistics, the deliveries out of the Shanghai Gold Exchange, they've, the ordinary people have acquired over 17,000 tons. And that's, that means that you've probably got close to 50,000 tons in China. Now, bearing in mind that, I mean, there's around about 200,000 tons of above ground gold. I mean, that's, that's a very substantial portion of it. The figures I get out of Russia is that Russia has got it in the region of about 11,200 tons. Now, that's come from not just the Reserve Bank's position, but also various other accounts, which there are two of them which are public. And if you add it all up, you can see it's around about that. I think that these central banks are very reluctant to let their citizens have this gold. They would rather sort of say, well, we've got gold, so it gives us, it should give you confidence in your currency. Yeah. What they're doing in the middle of Asia is actually they're following a different path. They're saying we will set up a currency for trade settlement purposes only, to replace the dollar. And that will be comprised of a mixture of commodities and also local currencies. Now, they've been planning this for some considerable time. And it seems to me, I mean, I could do this in an afternoon. It's easy. Don't include the currencies. That's a ridiculous situation. Nobody would agree. And what do you do when, say, there's a coup d'etat in Bishkek or something like that? I mean, and the currency goes haywire. I mean, this is just nonsense. You can't do that. And you can't put the restrictions onto the central banks of all the participating nations in that manner. And furthermore, it makes it very difficult for other nations to join the system. So the answer is quite simple. You just, if you're going to go down that route, then don't involve the currencies, just have commodities. And in a recent article, I showed how the price of these commodities, likely commodities in gold, I'm talking about commodities, we're talking about base metals, energy, we're talking about non-cyclical agricultural products, all things like that. It's quite clear that the volatility of these measured in gold is very minimal. All the volatility that we see in these commodity prices is actually the volatility is in the currencies, not the commodities. So it's actually very easy to put that scheme together. That's what they're doing, rather than committing their gold to backing their currencies.
Well, it is an interesting environment, and I appreciate how clearly you've laid things out there. It's unfortunately not the best news for all the people involved trying to survive these conditions. Although along those lines, you do offer some great research at Gold Money, and perhaps you could just let folks know a little bit more about what you're doing there and where they can find you.
Yeah, I'm head of research for Gold Money, and if you go to goldmoney.com, hit the research tab, that's one. You'll find all my articles down there, and it's not so much, my approach to this is I'm an advocate of sound money. It just so happens that sound money is legal money, and that is gold and silver. And that's been established by Roman law at the time of Justinian in the 6th century, I think it was. So this has been something that's been in the legal system for a hell of a long time. And you buy gold coin, you buy silver coin in order to hoard it. I mean, that actually is the word. You don't spend it. Gresham's law says you spend the rubbish first, and the rubbish is basically what your government issues without giving you the opportunity to exchange it for gold and silver. So that's my approach. I do an article every Thursday, which comes out sort of late morning, early afternoon EST, and I do a market report which sort of summarizes the previous week's activity on every Friday. So that's basically what I do. And while you're there, you might consider opening an account as well.
Yeah, and could you tell people about how the Gold Money account actually works and how that goes?
Yeah, sure. It's very simple. We act as custodian, or I think the legal term is bailee, of people's gold and silver. It doesn't appear on our balance sheet at all. And we arrange for your gold and silver to be deposited in a range of fully insured vaults, which are vault incumbers, which are companies which are members of the London Bullion Market Association. So your gold is fully insured. You can have it in a different location from where you live. So if you're worried that President Biden might try and do what Roosevelt did in 1933, you can have it held outside America, and then it'll just make it a bit harder for them to get it, to tap you for your gold and silver. So that's what we do. It's very, very simple. It's fairly low cost. You can buy and sell it through us. And the prices are all on the screen, so you can see exactly what you're doing. So if opening an account, you have to do the normal KYC and stuff. We're required to do that by law, and anyway, it does give protection to existing clients to ensure that people opening accounts are genuine and not money launderers, proceeds of crime, all that sort of stuff. So, yeah, I mean, it's as secure as we can possibly make it. And I think, what I would advocate is, people should have some gold and silver coins in their possession, but it does make sense to have the bulk of their wealth, which is not in fiat currencies and fiat-related assets, to have it in a vault, safe and secure, away from prying eyes. And that to me is a very sensible approach. And that's what we try and offer, basically.
Yeah, and I think that makes a lot of sense. I know people often say if you don't hold it, you don't own it, although there's probably, depending on how much gold or silver someone has, more than you want to leave in your safe at home. And either case, I appreciate what you're doing with Gold Money. I appreciate the research you're doing and helping to break down some of these topics, which do get complex. And just nice as always to catch up with you. And I appreciate your perspective and demeanor about these things. And just great to see you again. And we'll look forward to doing this again soon.
Yeah, I hope so. Thank you very much, Chris.
Well, thank you, Alasdair. Sure appreciate everything you shared there. Quite a body of knowledge that he has, and always great to check in with him and make some sense out of what's going on in some of these situations. Before we wrap up, I'd also like to thank Sierra Madre Gold and Silver, who brought us today's episode. And here's a quick word from Greg Liller, the executive chairman and COO, on some of the targets that Sierra Madre is going after.
We'd always said when we started this, we wanted to have 50 to 100 million ounces of silver equivalent in the ground, and wanted production in 3 years. I think when we complete the Guitarra deal, that will pretty much assure that production goal. Like I said, that mill's ready to start up. There's also a nice resource there in the old tailings that grades about a half-gram gold and over an ounce of silver per ton.
Well, thank you, Greg. And to find out a little bit more about how they're moving along these projects, here's the full clip where he shares some more detail coming your way now.